Okay, guys, I intentionally muted all your audio so that we wouldn't be having any holdback. So if you want to say anything, you can always type it as a message and then I would read it. Okay. So once more, I want to welcome you all to today's class, and I want to apologize for the lapses, the delay. It was never intentional, technical lapses and all that. So please, I am so sorry for coming behind time. All right. So on today's class, we'll be looking at stochastic indicator. We'll be looking at what they are, how they work, what it is and how it works, the mistake you should avoid when you are using it, and finally, we would consider how to use it correctly. Okay. So that is what we'll be looking at tonight. And I'm quite optimistic that at the end of this night's class, there'll be a shift in some of the things you know as regards trading. Okay, so we'll proceed. And please, I want to say something. The exchange you'll be using for this training is none other than ftx.com. It's a very good exchange that I've fallen in love with. Okay, those of you who used to know me or who were once my students, you know how I once talked about this exchange. I'm fully back into it. So all my trainings, all my classes will be carried out in this exchange. So please, if you're yet to sign in, if you're yet to join, kindly register ftx.com. You can use my referral link, Mr. Solution. Everything is together. There is no space. Mr. Solution. One word, Mr. Solution. Okay. And then at the end of this class, there will be a draw. There will be some lucky draw. So if you're able to ask some good questions, well, all questions are good, so to say. If you ask some questions and then you are fortunate to be selected, there will be some prize, there will be some gifts for you. All right, so we'll start off immediately. Okay. Okay, here is the FTS website that we'll be using. This is the FTS website. So let's choose BTC for our analysis tonight as the basis of our analysis. We'll be looking at BTC perpetual contracts. Okay, or maybe you could even choose another. Okay, BTC USDT. Okay, so this is the coin we'll be using for our analysis tonight. I'm waiting for it to load. All right, so first of all, some of us who are already conversant with trading or who are new to it, so to say, might be asking what is what are stochastics, or rather what is a stochastic indicator. All right, so stochastic indicator, I define it as a momentum, as that which measures the momentum of price. For instance, if you visualize a rocket that is going up, you discover that it will get to a point where it will have to slow down. It will slow down before picking up again. Okay, so as the rocket is going up in the air, before it can turn down, it must slow down. Okay, before it can start coming down, it needs to slow down. So that slowing down is a change in momentum. The momentum it was using initially when it was going up can't be the same momentum it will be using as it is coming down. So momentum always changes direction before price. That is one thing you would always have to understand about trading. Before the price of any coin can change, momentum first of all needs to change. Once you discover that a momentum has changed, that is it. The next thing that will occur is the change in price. Okay, so what stochastics help us to measure is this change in the momentum. Okay, once you discover that this momentum has changed, then the next thing that will follow is price. Okay, so to calculate the stochastic, most persons do not know how to go about this. Most persons do not know how to do this, but I think I'm going to just give us a little knowledge, or maybe a little mathematics behind calculating the stochastic, okay, the change in momentum or the stochastic of any coin you're trying to trade. Okay, so let's just do the let me just do the graphical illustration. Okay, I'll be using I'm using the whiteboard for this. All right, so assuming we have candles, this is a candle, okay? This is a candle, this another candle, this is another candle, okay? And then now here we have these are bullish candles, okay? And right here we have a little bearish candle, okay? Please don't mind my diagrammatic illustration, okay? So from here now, here was, let's say here is 50. Let's say the price here is 50, and to this point the price here is 100. This is 100, okay? And then the distance between here and, okay, you know, these are same level. Okay, let me just put it as if it's a chart. Okay, let me put it this way, as though it's a chart. Okay, and then the distance between here and this point happens to be 90. This is 90, okay? So these are candlesticks. So the point in the lowest point here was 50. The lowest point here was 100. And then the distance between here and here is actually 90, okay? So to calculate the stochastic, you simply find the difference between the last bearish candle. This is a bearish candle. Remember, initially the candle was going up and then this one came down. So these ones are bullish candle then, but this is a bearish candle. Okay, so these ones we are going up and this one came down. Okay, so to calculate stochastic, like I said, you just have to find the difference between the last bearish candle. This is the last bearish candle, okay, and the bottom. And this is the last bearish. The difference between this last bearish candle and this bottom, the difference between this last bearish candle and the bottom, and then divided by the difference between the highest, okay, divided by the difference between the highest and the lowest point of the candle. This is the highest point and this is the lowest point. So for us to do the calculation, stochastic, let me represent it with x, will now be equal to 90. This is 90 minus 50. Remember the formula I gave for it, divided by 100 minus 50. Okay, don't mind my handwriting. I'm not very good at that. Okay, remember the formula I gave for calculating the momentum of any price, or the momentum of any given coin at any point in time, that it is the difference between the last bearish candle, and the bottom. Okay, the difference between this and this, that's why we have 90 minus 50. Okay, and also divided by the difference between the highest points of the candle, that's the bullish candle, the highest point of the candle, and the lowest point. So the highest point is 100, right? The lowest is 50. Okay, so when you do the mathematics, we'll be having 90 minus 50 is 40. Okay, 40 divided by 100 minus 50, that's 50. Okay, so if you do the arithmetic, you'll be having, I think 40 divided by 60 should be giving us 0.8. 0.8. So when you multiply 0.8 by 100, you should 0.8 multiplied by 100 should be giving you 80. Okay, 80. Okay, so when you have this kind of candle, here, when you have this kind of candle setup, okay, look, for instance, look at what I'm just trying to say. This is the highest point. Okay, these are just a series of candles. Maybe you just want to analyze this region. Okay, you just do the same calculation we did there, the highest point and the lowest, the highest and the lowest. Okay, this is 1 hour. Let me change it to daily time frame. Okay, This is a daily time frame. Okay, so when you do the difference between the highest points, okay, the last bearish candle, and then the lowest point, then divide it by the difference between the highest point and then the lowest point, just as I did initially. It will give you the stochastic. Okay, right now here is the stochastic. This is the indicator. Okay, you can see that there are two lines here. You can see that there is the blue line and then there is a red line. Each of them play a role. Each of them, there is a role each of them play in any given chart. Okay, so when you look at this now, for instance, at this very point, you can see that the blue line crossed the blue line crossed the red line at this point. And if you check what the price did there, you discover that the price kind of went up. Okay, the price went up immediately. The blue line crossed the red line, the price went up. So, and then whenever the price gets to this region, this is the overbought region. And if you check very well, maybe you start backdating, you discover that whenever the price gets to the overbought region, the next thing that happens is that price starts falling. So the ideal thing to do when you are trading is stochastic. The basic thing everybody does is that when the price is at the overbought region, you short. That's for those who are trading futures or who are doing margin trading. Okay, so whenever you discover that the price is at the overbought region, this is the overbought region. And I want you to understand that this stochastic is graduated. Is okay, this is the setting I gave to this one. It's from 20 to 80. Okay, it's from 20 to 80. The 80 region, okay, from 20 to 100, sorry, from 20 to 100. So the 100th region, okay, is usually known as the overbought region. So once the price gets to that very point, okay, the next thing that will happen is that the price will start falling. And most times it's not a must that it will get to 100. Okay, but all these things are dependent on the volume and the momentum of the movement. Remember, like I said initially, that what stochastic does is that it measures the momentum of price. Okay, so sometimes it might not get to 100. If you check here, you see it got to, this is the highest point here was 98 points, 98.0531. Okay, and then what happened next? It started coming down. It started coming down, got to this very point. Okay, it consolidated a little, and then started going up again. Then got to this very point again, started coming. That was 96.0975. Okay, so that is the thing. So, but once the price started coming down, immediately it passed the overbought region, price started coming down. Okay, price started coming down. So what many people used to do, like whenever you want to know the next move that will be very determinant in the market, you have to consider the this point, this 20th point, so to say, usually considered as what is usually considered as the oversold region. And then the next thing that happens whenever the price of a coin is at the oversold region is that it will move in the reverse, and the reverse means it will start going up. Okay, so the ideal thing to do when you are margin trading or you're trading futures is to you long at the oversold region. By long, I mean you buy. Okay, you buy at the oversold region and then you short at the overbought region. This is for people who are trading futures. Those who are just into spot trading, you should only be concerned with when the price is at the overbought region. Okay, so it's because it's only when the price is at the overbought region that you can now sorry, it's only when the price is at the oversold region, please. Sorry for the correction. It's only when the price is at the oversold region that you can now buy and then anticipate a price movement. Okay, now that's all. That's that for that. The next thing I want us to consider is the positions of the red and the blue lines. These two lines play a pivotal role because the price is at, or that the two lines, or the line, either of the line is at the, either at the overbought or the oversold region, is not a guarantee that, it's not a guarantee that the opposite move will start occurring. So you have to pay particular attention to to the positions of the red and the blue line. The ideal thing to always do is that if you want to, if you want to buy, if you want to long, okay, you should first of all wait for the blue line to go above the red line. This is the blue line here, okay, this is the blue line. Then wait for you to cross the red line, okay. So if it doesn't cross the red line, it's not an indication that you should buy. There is a probability that the price will still come down. Okay, look at what happened. Okay, let's check this. Look at what happened here. Okay, you can see at this point, okay, price was actually going up. Okay, let me start from here. Okay, price was coming down, it kept on going down. Look at, if you even if you follow the candlesticks, you will still discover what I'm talking about. Price was coming down at this point, kept on coming down, kept on coming down, and before that, the blue line was already below the red line. Like the blue line had gone beneath the red line. So, but at this point, we discovered that the blue line sharply went above the red line. So immediately it crossed it. That was when we started seeing an uptrend. We started seeing a price movement upwards. Okay, it continued moving up to this very point. You can see at this point what happened. What happened was that the blue line went below the red line. Okay, the red line went on top, whereas the blue line went down, went beneath it. Okay, and then price started kept on going down, kept on going down, and then at this point, what happened again? It went above it. Okay, so that is the very point I want you to understand at this point, that you should pay particular attention. If you're trading the stochastic, you're using the stochastic as one of the indicators, you should always pay attention to the positions of the red and the blue line. Okay, one of the surest guarantees that you should long the market is when the blue line has gone above the red line. For instance, okay, look at this point. The price was at the oversold region at this point. Okay, so if I was trading this, I wouldn't be in a haste to buy. I wouldn't be in a haste to buy, because if you look at what happened there, okay, even though the price, even though the red line went above the, even though the blue line went above the red line for some time here, it didn't take long. It equally went lower than it. Okay, and then up to this very point where it crossed it. As it crossed it started going up again, and look at what happened there. Also, it went below it and price started falling. Okay, as we are pointing at these lines, also be relating it to the candle formation, the way the candles are forming. Okay, so currently we are seeing some downtrend in the price of Bitcoin. Currently is at 9,700 and 8,977. It's just that the purpose of this class is basically for stochastic. If not, would have used other indicators to also check what will happen. One of those indicators I usually love to combine with this is the Ichimoku cloud. Okay, but that's not what this class is for. All right, so now you can see the reason why the price of BTC is falling. You can see that at this point, this is the point, at this very point now, the blue line sharply went below the red line. Okay, the red line has been above, so that is why the price has been falling. Okay, and right now there is even no guarantee that the price is going to start going up again. Okay, so the price will keep on going down until there is a reversal, maybe when the blue line now goes above the red line. That is when price will start going up. But currently there is no guarantee. And remember that the time frame we are using is daily time frame. And then one thing we should understand about daily time frames, about time frames rather, is that the longer the time frame you're choosing, okay, the more it will play out. For instance, if I'm analyzing a chart using let me say I'm analyzing a chart using 30 minutes time frame, And let's say the 30 minutes time frame is telling me to buy, but then the let's say the daily time frame or the maybe any other higher time frame. Let's say I'm using 30 minutes, and then the daily time frame is telling me, the 30 minutes time frame is telling me to that the price will go up, and then the daily time frame is telling me that the price will still go down. I think even though I could play out a little bit, maybe I could just scalp using the 30 minutes time frame, but my emphasis, my attention will be more on the daily time frame, because the higher time frame will always truncate the shorter time frame. What the higher time frame shows will play out more in the market, especially those who are trading for the long term. What the higher time frame shows will play more than what the shorter time frame says. So people who are using shorter time frames basically are those who are maybe they are scalping, or maybe they are just they trading, so to say. Okay, so they just want to dabble in and dabble out without wasting time. So as you can see here, that the price of BTC from our stochastic, that the price of BTC is going down, and even though it's fastly approaching the oversold region. And remember what I said, that once the price gets to the oversold region, the next thing that will happen is that it will reverse and start going up. Now, even though it's at the oversold region, as you can see, you are not encouraged to go right in. Maybe you are not encouraged to long, so to say. But shorters, shorters, those who are sellers. That's for those who are trading futures and those who are into margin trading. Okay, so shorters are still dominating the market, sellers are dominating the market, and they still have an upper, obviously they will still have an upper hand. Okay, and if we can switch to lower time frame, and let me check what the lower time frame is showing. I want to exit the full screen of this. I want to exit the full screen. Okay. Sorry, I want to exit the full screen. Okay. I just exited the full screen. Okay. Now let's say I want to switch to a lower time frame. Like let's say I want to see how the market is faring in 30 minutes time frame using our stochastic. Whoa, you can see this long ass bearish candle. Like, this is very massive. And then look at our stochastic. What happened? You can see that at this point, look at it closely. You can see that at this point, the blue line sharply, like that was so fast, sharply went below the red line. That is why we have this rapid drop. At this point, they were kissing each other. So let me use the word kissing. They were kissing each other. But then after the next thing that happened is that there was a short. Immediately the blue line went below the red line. The price dropped. Okay. And please, there is something I want to emphasize on using indicators. Please, indicators can never function as standalone. They can never function as standalone factors when you're trading. You can't just use what one indicator is telling you to judge for the overall performance of the market. Okay. You can't use what the one indicator is saying to. Okay, I just read somebody make a statement that she can't hear anything. Please, I want you guys to type in the comment section. Can you hear me? Can you hear me, please? Please type in the comment section if you can hear me. I just read now somebody saying that he or she cannot hear. Please, has it been corrected? I'm sorry for that. Oh, thank you. Charles Uzo Diago. Okay, all right. Okay, thank you. I am sorry if you were not hearing me. I guess that was when we were having the technical lapses. I deeply apologize. Okay, so let's continue. Okay, all right. Thank you, guys. Thank you so much. All right, let's continue. I was saying that at this point, when the price got to this very point, you can see the immediately the blue line here went Immediately the blue line went below the red line. Look at, just follow this, follow this line. Sorry, follow this line here. Follow the line. If you trace it up, you can see that it was at this point that the blue line went below the red line, and next thing that followed is that there was this rapid drop. Okay, that was it. So let's also check out other smaller time frame, and maybe in our subsequent class we'll look at how to use the various time frames, because that's one of the problems people are facing when it comes to trading. If you check 30 minutes time frame, it's telling you to long, like you should buy, that the price will go up. If you check 15 minutes time frame, it will tell you that the price is going to fall. So most often than not, people get confused because they do not know which to obey. Are they going to obey the 30 minutes time frame, or are they going to obey the 15 minutes time frame, or are they going to obey the 5 minutes or the 1 hour and all that? Okay, so in one of our classes we are going to look at how to combine the various time frames. Okay, it's actually a knowledge I gained when I read one of the books written by Alexander Elder. Okay, he called it the 4 to 6 factor. We are going to look at that in one of our classes, how to combine the various time frames. Okay, so let's look at 1 hour. Let's see what the 1 hour time frame is telling us. Okay, at this point you can see that here the blue line has crossed above the red line, and there is a probability that the price is going to go up. But then remember what I said initially, the higher time frame will always truncate whatever thing the shorter time frame is telling you. You can just double in and double out, okay, but then you can't stay long in this kind of trade. Okay, because this is just 1 hour. This is what is playing out in the 1 hour. But look at the higher time frame, which is the daily time frame. What is the daily time frame telling us? It's telling us that the bears are still in control. As long as the higher time frame, the daily time frame is concerned, still means that the bears are still dominating this market. So even if you decide to trade with 1 hour or maybe 30 minutes or maybe any other lower time frame, and it's telling you to okay, look at it. It's telling you to long, like telling you to buy, that the price is going to increase. Sorry for I don't know if everybody here is trading futures, so that's why I'm actually interchanging long and shorts. Okay, just know that to long means to buy. You believe the price is going to go up. To short means to sell. You believe the price is going to go down. Okay, so that is the difference between long and short. So I think it has actually mastered me. I hardly talk about buy and sell. Okay, but please just understand, whenever I say long, I mean you are buying, and then when I say short, I mean you're selling, because your anticipation is that the price will start falling. That's when you short. Okay, and I just saw a comment say, let me check it out. Okay, all right, so thank you. Okay, so now the next thing we would always consider, like I said initially, do not trade off of one candlestick, of one indicator. I mean, do not allow what you are seeing with one indicator to make you make decisions, because why? Indicators are always lagging. Not all, so to say, because it's just one of the controversial topics, if indicators are truly lagging or if they are not lagging. There are some that are lagging, okay, because each indicator plays a role. There are momentum indicators, there are volume indicators, and the rest of them. So most of the mistakes people make is that they use the indicators that are for volume, like they could combine 2 or 3 indicators that are saying the same thing, showing the same result, or showing the same fact in the markets. They use they could combine these 3 indicators, and then maybe if the 3 indicators is telling them that they should long, I mean that they should buy, they would rush in and buy, and then immediately they buy, the price will start falling down, or rather the price will start coming down. So in between, they might just end up to say indicators don't work in the market. It is not true. Indicators work very well in the market. In fact, I am a scalper. I'm more or less a day trader. All my trades, I close it under a day. I do scalping. I put scalp for like 15 to 20 times in a day. That's what I do. That's my pattern of trading. Okay. And then most of the times I just use indicators. I know how to combine it perfectly. Okay. So one of the topics we probably handle is how to combine indicators perfectly. Okay. How to combine indicators so that you don't make the mistake of using 3 indicators, because the ideal thing people say is that don't trade with just 1 indicator. Make sure you combine 2 or 3 indicators and then combine joining with price action to make a massive killing in the market. Okay, but then you don't just combine 2 indicators. We have to know what you are combining. Can't combine 2 indicators that whose function is to tell you, or is to detect the volume, or whose function is to detect the momentum, okay, of price change and all that. No, we have to know how to combine it effectively. We'll still look at that as you go on. Okay, so let's look at the next thing we have on our slide. Okay, so I said, okay, this is actually my opening statement. I said the market does not care how much you're willing to lose. The market only cares about market structure. Okay, this is actually this issue came up when I was handling one class on the emotion management in trading. Okay, so the market doesn't want to know you have maybe you have a $10,000 account. You are telling yourself you can only risk that what you are risking is 10% of it, and that's about $1,000, $8,000. The market doesn't care about that. The only thing that markets want to know is the market structure, and that is the only thing it will respect. Okay, so even if you have a good sound money management, but then you are not paying keen attention to market structure, you will end up making some mistakes. Okay, so the next thing we are looking at is the mistake to avoid whenever you are using the stochastic. What are the mistakes people do make when they're using the stochastic? Okay, here I said that you should focus on the charts. Do not short because you feel the market is overbought, and do not trade against the momentum. Follow the trend. What do I mean? Look at this this very coin we analyze now. That the price is at the overbought region is not really an indication or indicator that the price will start going down. Look at what happened there. Okay, look at what happened there now. Even though the price, okay, look at it here. Look at it. The price here, yes, the price here was at the overbought region. Yeah, even though it fell, okay, it fell, then got to this very point again, started going up. So you should not always be in a haste to long or short, maybe because the price is at the overbought or the oversold region. Always pay attention to the positions of the red line. In fact, the positions of the red and the blue line is far better than whatever it is. Maybe if the price is at the overbought or the oversold region, the positions of the red and the red and the blue indicate the red and the blue lines will always truncate whether the price is at the overbought or the oversold region. Okay, so that's what that point is trying to tell us. And then the next thing is I said, do not trade against the momentum. What do I mean by not trading against the momentum? Okay, look at the momentum of the price momentum. Okay, let's just start from this region. Let me do it this way. Okay, look at here, the whole of this region now. Look at the whole of this region. Look at here. Look at here. Oh, I should change the color of this. Let me use white, I guess it should be bright. Okay, look at this region now. Okay, look at this region. What is the momentum? Like, what is the momentum showing us here? It's showing us that the price is actually falling. Okay, do not make the mistake of maybe because you've seen that the blue line somewhat went above the red line, you should go right ahead and long. pay particular attention to the momentum. In fact, this is the market structure generally. The market structure will always be ahead of whatever your indicators are telling you. In fact, some persons who do not believe in indicators, even though I believe in them because I know how to perfectly combine them, they said their only concern is on price action and the market structure. Okay, so but the market structure will always supersede whatever the indicator is saying. Okay, so the market structure generally that this is a bearish market, like at this point now, look at it, starting from here, starting from this point, you can see that the price actually changed. If you look at maybe want to draw the trend and want to check the trend line, look at it that from here, price started making a series of what lower lows. Let me, okay, from here, okay, okay, from here generally, you can see from here, price has been making a series of what lower lows, like it's been going down. So this is actually the general market structure. The structure is that it is actually going down. Okay, that's what I meant that by saying that you should pay attention to the momentum. Okay, pay attention to the momentum. And then the next point we have here is that you should, okay, how to use the stochastic indicator. Here I said it is used to time when the pullback will end. Okay, stochastic is used to time when the pullback will end. If the pullback ends, the next thing that will happen is that the price will start going up. That is the role of the blue and the red line. Once you see that the red line has, the blue line has gone above the red line, you just know that the price will start going up. But then pay attention to the momentum and or the market structure, so to say. Okay, and then the next thing that the stochastic helps us do is that, okay, here I said that do not always be fast to enter a trade. Always look out for confirmations. Thank you. Okay, that is for those who just want to trade off one indicator. Like I said, don't just use one indicator to conclude. Do not use one indicator to conclude. Okay, let me remove this. Okay, do not use one indicators to conclude. Do not be fast to enter a trade. Always look out for confirmations. Okay, and what do I mean by this confirmation? Okay, you could look out for maybe maybe a bearish engulfing candle or maybe a bullish engulfing candle. I'm trying to see something. Okay, look at the, okay, look at this very point now, at this region, at this point. Okay, I'm trying to just to get a typical example of why you should always look out for and a confirmation. Okay, let's just take this very example. It's near what I want to explain, even though it's not the perfect thing I need, but it's near what I want to talk about. Okay, you can see that at this point, you can see that at this point, for here, price went down and all that. The price was bearish, but then at this point, you can see this candle that formed. But at this you can see this candle that the bulls were about to take over. Okay, even and then the next candle that formed kind of if you measure this, if you check the difference between from here where this price fell, from this point where the price fell to this very region where the price started going up, you see that the bullish candle is higher in length. In other words, the bulls have more strength than the bulls had more strength here than the bears. Okay, so it's actually a confirmation that will tell you that the bulls are actually taking over, even though yes, there was a little consolidation as the market kept on moving. Yes, that is expected. Market never moves in a straight line. It never goes straight. Okay, there will be some consolidations. There will be a series of up and down movement. Like I said, it's just like a jet a jet that is taking off. You don't expect it to keep on going up like that. Sometimes you have to gather speed. If it gathers momentum, it will still continue. So at this very point, this is actually a confirmation that the bulls are actually in control. Okay, they were in control up to this very point. Okay, if you look at our stochastic, you can see that it was at this point that the red line started going below the blue line. Okay, so at this point the BS took control. Okay, so that's what I meant by looking out for confirmations. Okay, do not always be fast to enter a trade. Always look out for confirmations. And then I said that if the market is in a downtrend, you look out for the overbought areas to go short. And if the market is in an uptrend, look for oversold areas to go long. The same thing I actually said about the market structure. Please, no matter what the indicator is telling you, always look out for market structure. And how do you know this market structure? Is by drawing your trend, knowing your trend lines. Okay, if a price is making a series of lower lows, is an indicator that is the price is bearish. If it's making a series of higher high, it's a bullish market. Okay, but there is something else I normally do. I want to use my moving averages. Moving average is actually one of the things that help me to know the general MA. Let me just put MA, the general setup of the market, moving average. And I normally use 200 moving average. Okay, let me set it. Moving average, let me set it to 200. Okay, just 200 moving average. 200 moving average, 200. Okay, I could expand this to know if you give me what I want. Okay. Okay. All right, this is what I meant. Okay, this is actually my 200 moving average. So the ideal thing here is that if the price is above the 200 moving average, it means we are in a bullish market. This is it now. This is the 200. This line, this orange line is the 200 moving average. So once the price is above this 200 moving average, it means that we are in a bullish market, so to say. But then if the price goes below the 200 moving average, it means we are in a bearish market. Just look at what is actually playing out here. At this point, when we saw this sharp drop at 24th of June, okay, when we saw this sharp drop, that was when the price went below the 200 moving average, and all this while price has actually been bearish. Okay, so we can actually talk about a bullish market again when the price eventually goes above the 200 moving average. So that is what I meant by you go long in a bullish. If the price structure is bullish, you go long. If the price structure is bearish, okay, you go short. So that's the point I was trying to make here by saying that the market is in a downtrend. You look for the overbought areas, okay, to go short, yes. And if the market is in an uptrend, you look for areas to go long. That's the point I was just trying to make there. All right. So yeah, I said always look out for entry triggers. What do I mean by entry trigger? Those same confirmations I talked about. Maybe bullish engulfing, bearish candle, bearish engulfing, or maybe doji, hammer, and all that, the role they play. And then you know that one mistake you should never make is allowing one candle formation to decide what you're going to do in the market. No, you don't just memorize candlesticks and maybe allowing, when you see this one, say this is doji, this is morning star, this is hammer, this and all that. No, you combine the candles together. It's what the combination of the candle tells you that will help you to make rational decisions. You don't just trade, just as you can never trade with what one indicator is telling you in the market. Do not make the mistake of allowing what one candlestick is telling you to make your decision. Why? It takes up to 100 candlesticks to form a market structure. Okay, so if it takes up to up to 100 candlesticks to form a market structure, why would you not allow just one um, um, candlestick formation? Let me just show us what I mean by that. Look at, okay, here now you can see that okay, assuming there is no 200 moving, assuming we don't have this here, let me just close it. Let me remove it. Okay, assuming there is no 200 moving average, and currently the price here is at the over this, the price here is increasing. Maybe you saw this big ass candle and then you tell yourself, oh my, the price is going to the next place this price is getting to is 9,400. You now go long because of just what candlestick is telling. What candlestick? Look at the overall structure of the price. You see that it's been going down, so to say. So you don't allow just what one candlestick tells you to help you to make your decision, because it takes more than about 100 candlesticks, okay, to be more realistic. It takes about 100 candlesticks to form a market structure. So don't just make your decision off of what one candlestick is showing. So that's the point I was trying to make here. And then I said there, okay, finally, I'm just trying to recap what we talked about. Here I said, do not blindly trade overbought and oversold signal. I said it initially. Do not blindly trade overbought and oversold signals. Follow the trend. In fact, there is a popular maxim that says, the trend is your friend until it bends. The trend is your friend until it bends. The trend will always be dominating the market until it changes. There is even a law. There is even a law about can I still remember it now? There is a law that has to do with is it law of price? I'm just trying to know if I can still remember it now. I came across it in one book I was reading, and it kind of made sense to me. It rejuvenated with me. Let me know if I can recall that law. Oh, I can't really place it now. Okay. Okay. Yeah. And I remember it's called the market law of motion. It says that if the market is moving downward, it will continue to move in the direction until an opposite force comes into play. You remember this law in physics, law of motion, Newton's law of motion, one of Newton's law of motion. An object will continue to move in a given direction until an opposite force acts on it. The same thing is also applicable to cryptocurrency trading or the price. If the market is moving downward, it will continue to move in that direction until an opposite force comes into play. The same, you can also apply this thing to this stochastic we talked about. Once the blue line has gone above the red line, the price will keep on going down until the red line now comes above, or until the blue line now goes below the red line. That is when the market price will change. Okay, so that's why I say do not blindly trade overbought and oversold signals. Follow the trend, and please always recite this thing. I actually have it here in my trading desk. The trend is your friend until it bends. I have it here. I wrote it down and pasted it here so that it will always guide me anytime I'm looking at the market. Okay. So the next thing I said is that you always time when a pullback will end. And how do you time when a pullback will end? It is by the knowledge of that stochastic. Stochastic will help you to time when the pullback will end, and then the market structure. I keep emphasizing on this market structure and also the price action, because that is what trading is all about. Okay, always look out for the market structure. Is the price, is the market, is in, are we in a bullish market, are we in a bearish market? Okay, so those things should always be at the back of your mind. And then remember what I said in the beginning, that higher time frame will always supersede your shorter time frame. What the higher time frame is saying will always be higher than what the short time frame is saying. Short time frame, you use it to know the best place to enter. That is just one of the uses. Or maybe you're a day trader, like day trader like myself, you use it to know when to enter, when to get out immediately. Okay, so time when a pullback will end. And then the next thing is that filter your trading setups. Always filter your trading setups. Don't just blindly trade. Filter your trading setups. And how do you filter these trading setups? It is by looking at your candle formation, the nature of the candle, and all that. That is what helps you to filter your market setup. Okay, and then look out for entry triggers. We talked about it in the beginning. Look out for entry triggers. Look out for, maybe you want to go long. Look out for such things that will help you to know if you should go long. Maybe bearish engulfing, hammer, and the rest of it. But pay attention to market structure as well, so that even if you're going long, you should know when you should be taking your profit. At what point are you supposed to be taking your profit? Okay, so I want to thank you all for making our time to come to this class, and I'll be looking at the comments set to know if there is any question. I'm going to be going through the questions to know those who have been following all we've been teaching so far. Okay. All right. It says, sorry. Okay. This is okay. I'm sure you must have gotten it when I say that to long means to buy, to short means to sell. Please, yeah, long, you are buying because you feel the price will increase. Short, you are selling because you feel the price will decrease. But this is actually for people that make money when the price is falling. These are future, those who trade futures. Okay, so I want to take your questions. I want to know those who have been following me, and you know that this is one of the this is at the area where we get to choose people who will fully qualify for our $10 giveaway, courtesy of the FTS exchange. And then if you have not joined the Telegram group, please, that is one of the criteria, that is one of the conditions that must be met before. Look at the Telegram group, t.me, that telegram.me/FTS_Africa. In fact, if you just go to your Telegram, search for, type FTS_Africa, you will see them there. Okay, make sure you join the group, and also make sure you have an account that, because that is where they are going to send you this token if you qualify. Okay, so I'm going to go through the messages to know. Okay, Thelma Opurum, he said, is the stochastics related to the RSI? If so, how can we use it together? Actually, remember what I said in, okay, if you listened attentively, I said there are some indicators that play the same role, that say the same thing or show the same information in the markets. And fortunately, or rather, should I say unfortunately, actually, as a matter of fact, let me use it as a matter of fact now. As a matter of fact, stochastics and RSI, they are actually momentum indicators in the markets. Okay, so do not combine two of them together and then believe that you've made a decision. Okay, but there is actually a difference between the stochastic and the RSI. RSI only has one line, but the stochastics has two lines. If you look at it here, let's just go to the chart once more. I want to exit this. I want to exit this. Okay, so that, okay, look at this is stochastic. We want to look at RSI. Okay, relative strength index. That's RSI. Okay, you can see, like I said, stochastic has two lines, the red and the blue, but then RSI has only one line. And remember what I said? I said both of them are what? Momentum indicators. Both of them are momentum indicators. Whatever this one is telling you, that is what this other one is telling you. Okay, so do not make the mistake of combining the two of them. And when they ask you, you tell them your stochastic said you should go long, and your stochastic said you should go long, and your RSI said you should go long. Okay, so don't make the mistake of combining the two of them to make your decision, because they are all saying the same thing. Okay, so that's just what I want you to understand. Thank you for that question. I think it's one of the questions that has qualified for the $10 giveaway. And the next question I'll be looking at is okay. I'm finding, okay. Our first winner there is Thelma Opurum. Okay. Okay. The blue and red line in the stochastic, that's from Charles Uzodiago. The blue and red line in the stochastic, is it default, or we have to set it in a specific way? It's actually default. It comes with it. It is a software already installed there, so you're not setting anything. The only thing you could set might just be the points, your overbought and oversold region. Okay, what do I mean? Look at it. This is this stochastic. You can decide to edit it. Just go to this point now. You can just decide to change some things. Here we have 14. Maybe you could decide to make it 13, and then the smoothie and the smooth care and all that. So that is just the only, but I prefer to use the default setting it came with. Okay, so that is it. So the next question, and which is the final one. Okay. Okay, humility. And it is important it is important to what for. Okay, I think you wanted to write wait. It is important to wait for confirmation before entering any trade. What confirmation do stochastic give us? What confirmation does stochastic give us? Actually, it is a momentum indicator, like I said. It is a momentum indicator. It tells us the change or the intensity of the price change in the markets. Okay, so that is what stochastic tells us. And if I got your question very well, okay, please, this video is recorded, so you can always go through the YouTube channel to watch it for better clarity. But the essence of joining the class is maybe you have some bias, you need to be cleared on something. That's why it's always good for you to join the class and get clarified. If you have some bias or some things you've not really quite understood, you are at liberty, or you have the chance of asking for clarification in the live video or in the live chat, which you might not which if you ask it when the video had already been uploaded, the person might not be disposed to answer the question. So it's always good for you to participate in the online class and then ask questions for better clarification. All right, guys, in the absence of any other question, I want to thank all of you. Adebayo, my boss, Tony, Charles, Chibuzo, these are my Chris and the rest of you who made our time to come for this class. I deeply want to appreciate you for the effort, and please follow FTS Africa channel, Telegram channel, and also follow them on YouTube. In fact, all their social media handles, you are expected to follow, because these are the conditions that must be met before you can qualify for their giveaway. Okay, so thank you very, very much for making our time to this class. I'll see you in the subsequent